So what we're looking today is a range of questions based in around the investment strategy for Monique and Ralph's files. So we'll pull apart the strategy and we'll basically compare because Atticus believes it's not in the best interest of the clients. So happy to get started on it. If someone would like to kick off with our questions.
Yep, so what's the impact on the recommendation?
Yeah, so what we want to do is we want to base our investment strategy on the modern portfolio theory, which relates to the portions or the risks and returns of various assets. So it seeks to use mathematical modelling to select a combination of investment assets that, as a collection, face lower risks overall than any other investments by themselves. So we're basically offsetting our chance of risk through strategies such as dollar cost averaging, and making the same consistent investment over a long period of time and reinvesting our dividends. So in our aggressive portfolio, we've built a series of ETFs, which essentially is a range of shares bundled up into one unit with a diluted weighting rather than direct investments at a higher risk. The advantage of doing this is this will offset risks as well as generate opportunity, as well as we'll be pooling funds together, investing more in assets. This strategy is one that we can review moving forward, and as we're growing, diversifying the portfolio as per the client's needs. So we look at as well from the car park side of things as well too. Is the income coming in from the car park? What are we doing with those funds? At this point in time, the car park has a great yield, low costs, which should also open up into us diversifying and building an overall portfolio. Issue is if the car park does tend to cost more money, or costs are higher, but there is a guarantee rate on that car park. So quite minimal impact depending on what the markets do. But we are offsetting our risk through a DCA strategy, reinvesting our dividends and holding as a long-term investment.
Okay, great. So the economic climate and outlook?
Yeah, so the economic climate and the outlook. So looking at the growth type assets, infrastructure development is what the government will look to invest more into as it's looking to kickstart growth and create jobs, and the investment in a direct property fund will particularly help because that creates jobs and basically builds infrastructure when we do look at that. So the risk is if the infrastructure spending slows, but however it's not going to completely stop. The Macquarie High Conviction Fund holds majority weightings in financial services, energy, industrial, consumer, clinical and basic materials. Again, similar as supply, but only if expenditure reduces. And however, financial institutions hold the highest rating, and banks are always going to make money. And by having multiple exposure in different assets, we can net against the losses. Also, well, we may be missing some possible gains, but however, from a diversification point of view, we're bargaining away the right to make a killing for the right not to be killed.
So what's the relevance?
Yeah, so again, we're looking to be quite aggressive, which means we're looking at funds or direct investments in international and domestic equities and properties. As diversification is the key and only having 8,000 to invest, we want to get the maximum exposure for the limited funds we have. I've included the portfolios that we're looking at from an implications of using these funds is that the management fees may be higher than direct investment, but however, we're using pooled assets which will minimise our chance of loss. So if we look at the Macquarie High Conviction Fund in particular, ANZ's got a 10% weighting in there, BHP, AGL, Woodside. These are all companies that people know how it's been performing. It's been outperforming the index substantially over a period of time. A 99% domestic weighting. So again, quite aggressive, where the Cromwell direct property side of things is the other one we're looking at, where it's looking to achieve a rate of 7% per annum. And we can see over, if we look at the 3-year historical data, 11.5% return, 6.6% growth. We're getting good growth even through a negative period. There's still growth of 4.4% and an income close to 3%. So, averaging the growth out over a 3-year period, you're looking at about 5% growth. When we do look at it, the fees, the fees are in particular a little bit higher, but again, with what we've got, we want to try and grow those funds and branch out with our investment portfolio, and with that, that's a good place to start when we do look at it all. So, is there any other questions, or have we covered off on everything?
Yeah, we've covered off on everything.
Okay, so as you can see, is the strategy is quite relevant to what the clients are looking to do, and really it fits in with their current needs, circumstances, and goals they want to achieve, with where they're sitting with funds available, with loans that they need to reduce as well too. So that's the theory behind the investment strategy moving forward. So if anyone has any more questions, please feel free to come and see me, or send me an email, and we'll go from there.